I want you to picture a scenario, one that I think every single person listening to this has experienced at least once, or, at least witnessed in the
Oh,
office.
absolutely. I think I know where you're going with this.
Yeah, so it is Friday afternoon, just
Yeah.
after lunch. The mood in the office is actually pretty good. The sales director walks in. Let us call him Dave. And Dave is just beaming.
He just closed the big one.
Exactly. He closed the deal of the quarter, a massive order. We are talking $500,000 of industrial pumps going to some new construction conglomerate.
The absolute make-or-break deal. I know it entirely too well.
Right. So Dave hands the paperwork to a customer service rep. She types it into SAP, order number 12345. She is smiling. He is smiling. She hits save. The spinning wheel of death for a second, and then a red bar pops up at the very bottom of the screen. Credit limit exceeded.
And just like that, the air completely leaves the room.
It really does. But it is not just an error message, though, is it? I mean, it is a total stoppage. Logistics execution just dies.
Everything stops.
The warehouse does not get the pick ticket. The truck does not get booked. And suddenly, Dave is not smiling anymore. He is screaming about how the system is preventing him from doing his job. It feels like the software is the literal enemy of revenue.
It definitely feels that way to sales. Sure, it is the classic friction point in any enterprise. You have sales, whose entire job and compensation structure is based on pushing product out the door.
Right.
And then you have finance, whose job is to make sure we actually get paid for that product. And sitting right in the middle, taking the bullets from both sides, is you, the SAP consultant.
So that is exactly what we are digging into today for this deep dive, the credit block. But I do not want to do the standard, here is how you release an order tutorial.
No, anyone can look up transaction VKM3 on a wiki.
Exactly. I want to understand the mechanics of the Guardian because you have told me before that this error message is not a glitch. It is actually the system working perfectly.
It is the system acting as a fiduciary guardian. Yes. Look, if you ship $500,000 of pumps to a company that is already 90 days overdue on their last 3 invoices, you have not made a sale.
You've made a donation.
You have made a very heavy, very expensive donation. The credit management module in SAPSD is the gatekeeper that prevents that donation from ever leaving the loading dock.
But it is incredibly complicated. I was looking at the source notes for this deep dive, and the complexity under the hood is staggering. We aren't just comparing an order value versus a flat limit.
Not at all.
There is time phase logic, risk categories, ghost data, and now, with the move to S/4HANA, it looks like the entire architecture has been ripped out and replaced.
It has been completely revolutionized.
Yeah.
And that is why our mission today is to move you, the listener, from being just a troubleshooter.
Yeah.
Someone who just reacts to a help desk ticket.
Right, to a true subject matter expert.
Exactly. A troubleshooter sees a block and asks, how do I clear this? An expert asks, why did this happen? Is the underlying math right? And is the configuration actually aligning with the company's actual risk tolerance?
And that is a really dangerous distinction, right?
Yeah.
Because if I just go in and unblock an order without knowing why it blocked in the first place.
You are gambling with the company's working capital, period.
Huh.
I have seen junior consultants unblock orders just because Dave, the sales director, was screaming at them, only to have that customer file for bankruptcy 2 weeks later.
Oh, wow.
Yeah, that consultant had a very, very uncomfortable meeting with the CFO afterward.
I can imagine.
Yeah.
So to help you avoid those uncomfortable meetings, we have a roadmap for today. We are going to break down the logic flow. What happens in the exact millisecond you hit save?
Crucial to understand.
We are also going to tear apart the exposure math, which is way more than just unpaid bills. We will spend a lot of time in the engine room, transaction OVA ape, because that is where the real consulting happens.
It is the brain of the whole operation.
And finally, we have to talk about the S/4HANA revolution. Because if you are still thinking in terms of the old transaction codes, you are officially obsolete.
Obsolete is a harsh word, but it is accurate. If you try to use FD32 in a modern system, you are going to hit a brick wall.
Let us start at the very beginning then, the logic flow. I am the sales rep. I hit save on the sales order. To me, it feels instantaneous, but inside the black box, there is a whole decision tree running. What is the very first thing SAP checks?
It happens in milliseconds, like you said.
Yeah.
But the sequence is incredibly rigid. The very first question SAP asks itself is, does this customer even matter?
Does this customer matter? That sounds a bit existential for a piece of software.
In terms of credit, yes, it is existential. The system checks the customer master data first. Specifically, it looks to see if the customer is assigned to a credit control area. a CCA.
Define that for us. What exactly is a credit control area?
Think of the CCA as the legal jurisdiction for risk. If you are a massive global company, you might have one CCA for North America and a completely different one for Europe.
Because the currencies and risk profiles are different.
Exactly. Or you might choose to have one global CCA if you want to manage risk centrally across the whole planet. But the key here is if the customer is not assigned to a CCA, or if the specific credit management active flag is not picked in their master's record.
The system just bails out.
It bails out immediately. It essentially says, not my problem, and the order saves without a single credit check being performed.
Okay, so step 1 is checking if the lights are even on for credit management. Let us assume they are. I am assigned to the North American CCA. What is next?
Step 2 is the risk category. This is where we start profiling the customers. Because not every customer is the same. You have massive, stable corporations like Walmart, and then you have Bob's Bait Shop down the street.
You cannot treat them the same way.
You really can't. The risk category allows us to group customers by reliability. You might configure category 001 for high risk, 002 for low risk, maybe a special VIP category for government contracts, and so on.
So this categorization is attached directly to the customer master as well.
Correct. And this is vital because the actual rules we apply later in the process will depend entirely on this specific category. You might let a VIP customer go 10% over their limit without blinking, but a high-risk customer gets blocked at exactly 100.01%.
Okay, so now the system knows who the customer is and how risky they are. What is step 3?
Step 3 is the system asking, what are we doing right now? This is the credit group. It establishes the transaction context. Are we creating a sales order? Are we creating a delivery? Or are we posting the goods issue?
Why does that distinction matter, though? Do we not just check their credit when they initially agree to buy the product?
That is a rookie mistake and a dangerous one. Yeah. Imagine you place an order with me today. It passes credit perfectly, but you tell me you do not want the goods actually delivered for 3 months.
Okay.
In those 3 months, the market crashes and your company goes flat broke. If I do not check your credit again at the time of delivery or goods issue, I might ship $500,000 of pumps to a bankrupt customer just because they were solvent 90 days ago.
Ah, I see. So the subsequent checks are basically a re-verification of health.
Exactly. It is a safety net. We assign a credit group to the document type. Orders are usually group 01, deliveries are group 02. This allows us to configure different strictness levels based on how close the goods are to leaving the building.
So maybe at the order level, we just give a warning message so sales can at least get it in the system.
Right. But at the delivery level, when the truck is literally backing up to the dock, we set a hard error block. No goods leave without clearance.
So we have the 3 ingredients now: the customer CCA, their risk category, and the transaction group.
And this leads us to the grand finale, step 4. The system takes those 3 keys, CCA, risk category, and credit group, and it runs to the configuration table in transaction OVA8.
To look for a match.
Yes, it looks for a matching record for that specific combination. If it finds one, it executes the mathematical rules hidden inside that config.
And if the math says they fail,
then it immediately updates the document status. In the database, specifically in table VBAK for sales orders, there is a status field called CMGST. The system flips that switch to the letter B.
B for blocked.
B for bad news. And until that B is manually changed to a D, which stands for released, nothing moves. The supply chain is frozen for that order.
Okay, that makes the flow really clear. But the part that always confuses me, and I think it confuses a lot of junior consultants too, is the actual math. When the system throws that red error and says you have exceeded your limit, what exactly is it counting?
This is the total exposure equation, and it is the biggest source of arguments between sales and finance. Most people, especially in sales, think exposure just equals unpaid invoices.
Right. If I have a $100,000 limit and I have $50,000 in unpaid bills sitting in accounting, I should have $50,000 left to spend today.
It is logical logic, but in SAP, it is completely wrong. It is dangerously wrong. SAP calculates total exposure as the sum of 4 distinct buckets: open orders, open deliveries, open billing documents, and open receivables.
Let us break those down one by one, because counting open orders sounds highly controversial. You are telling me that if I place an order for 50 grand, but you have not shipped it, and I obviously have not received it yet, that still counts against my credit limit.
It has to count. Think about it from the manufacturer's perspective. When you book that order, I am reserving physical inventory for you. I might be purchasing raw materials, to custom build your pumps. I am effectively allocating my working capital to you.
Oh, I see. It is an opportunity cost.
Precisely. If I let you stack up $2 million in open orders on a $100,000 credit limit, even if I have not shipped a single dime yet, I am taking a massive, massive risk. What if you cancel all of it? What if you go under? I am stuck holding the bag with all that inventory.
Okay, that totally makes sense when you frame it as risk allocation. So open orders are component one.
Right. Component 2 is open deliveries. This is what I call the danger zone. The delivery node has been created. The warehouse is actively picking the goods. The boxes are moving toward the shipping door.
Why is this tracked as a separate bucket from open orders?
Because technically, once a delivery document is created, the original sales order is considered closed for that specific quantity. The financial value moves out of the order bucket and into the delivery bucket.
Ah, so if you did not count open deliveries, there would be a blind spot.
A massive loophole. The exposure would just magically disappear during the picking process, and the customer would suddenly look like they had free credit just because the goods were on a forklift.
Got it. It is a baton pass of liability.
Exactly. Then we have component 3, which is open billing. This is a weird limbo state. The goods have been physically issued. The post-goods issue, or PGI, is done. The inventory is gone from our warehouse, but the invoice has not successfully posted to accounting yet.
How often does that actually happen, though? Is the billing to accounting step not entirely automatic in SAP?
In a perfect world, yes, it is instant. In the real world, it fails all the time. You might have a posting block on the customer, a general ledger account determination error, or maybe a tax interface failure with an external system.
So the invoice exists in the SD module, but finance does not see the debt yet.
Exactly. If we did not count the open billing bucket, the customer would essentially get free, untracked credit during that technical glitch. We have to count it.
And finally, component 4, open receivables.
The classic unpaid bill. The invoice has made it to the BSID table in finance. It is just sitting there, aging on the ledger, waiting for a check to arrive in the mail.
So the total exposure is the strict sum of all 4 of those buckets. And if that combined number is even $1 higher than the master data limit,
it is an absolute binary decision.
This perfectly explains why customers and sales reps get so incredibly mad. They look at their aging report from finance and say, look, I only owe you $20,000. And you have to sit there and explain, yes, but you have $80,000 of new orders sitting in the warehouse waiting for trucks.
Precisely. And that conversation requires you, the consultant, to deeply understand that math. If you cannot explain those 4 buckets clearly, you will lose the argument with sales every single time.
Let us move into the engine room. Transaction OVA8. You called this earlier the most critical transaction in the entire module.
It really is the brain.
Yeah.
It is where you define the actual rules of engagement. We talked about that key combination earlier, the CCA, the risk category, and the credit group. OVA8 is where you configure what actually triggers a block for that specific trio.
I am actually looking at a screenshot of OVA8 right now in the source material, and there are a ton of checkboxes. Let us talk about the static credit limit check first. This is basically the vanilla standard check, right?
It is by far the most common. It simply compares that total exposure calculation we just talked about against the credit limit. But here is the critical consulting nuance. Inside the configuration for the static check, you have checkboxes that literally say open orders and open delivery.
Wait, you can just turn those buckets off.
You absolutely can.
Yeah.
And this is a huge strategic consulting decision. I have had clients look at me and say, we do not want to penalize our customers for open orders.
Or left out.
Only block them if they actually owe us hard money and receivables.
So you just uncheck open orders in OVA8. That sounds wildly risky.
It is incredibly risky. It means a customer with a tiny $10,000 limit could theoretically book $1 million in orders, and the system will not stop them at all until the very first $10,000 is actually billed and hits accounting. By then, it is way too late.
But I guess some companies prioritize aggressive market share over strict risk management.
Exactly. It is a toggle switch for business strategy, not just a technical setting.
Now, contrast that static check with the dynamic credit limit check. That just sounds fancier.
It is much smarter. If the static check is a photograph of right now, the dynamic check is a movie. The dynamic check introduces the concept of the horizon.
Explain the horizon for us.
Let us say we go into OVA8 and set a time horizon of 3 months. The system looks at your open orders. If you place an order for delivery tomorrow, it falls inside that 3-month horizon. So it counts against your credit limit.
Okay.
But if you place an order today for delivery 6 months from now, the system sees that the delivery date is outside the horizon.
And it does what?
It completely ignores it. It says, that liability is way out in the future. I am not going to eat up your available credit line today for a risk that does not even materialize for half a year.
That is brilliant, because if I am a seasonal business, say I sell winter snowblowers or something, I might be booking massive stocking orders in July for delivery in November.
Right.
If the system used a static check, my credit would be maxed out in July, and I couldn't buy any normal spare parts for my day-to-day business all summer.
Exactly. The dynamic check aligns the credit block with the actual physical flow of goods over time. It frees up working capital for immediate needs while still keeping a strict eye on the near-term risk. It is a much more elegant solution.
What about this one here, the document value check? This one does not seem to look at the total credit limit at all.
No, it doesn't. This is a specific control on the transaction itself. In the industry, we affectionately call it fat finger protection.
I really like that name.
It is a very real problem. Imagine a junior sales rep, fresh out of college, working his first week. He is entering an order for 100 units. But his phone buzzes, he gets distracted, and he accidentally holds down the 0 key and enters 10,000 units.
And suddenly a $5,000 order becomes a $500,000 order.
Right. Now, if the customer is a massive global conglomerate like General Electric, they might have a $10 million credit limit on file. A standard static limit check would let that $500,000 error slide right through without a peep because they have plenty of room.
But the warehouse would completely freak out when the picket prints.
The warehouse would freak out, production schedules would skew wildly, and you would potentially ship a mountain of unintended product. The document value check prevents this by setting a hard cap per individual order. You configure it to say, no single order document can exceed $50,000, period. If it does, it blocks for manual review. It acts as a mandatory sanity check.
I can definitely see the value in that. But surely there is a downside. If I am a global company, $50,000 means something very different in the U.S. than it does in, say, a market using a different currency scale.
You found the trap. The value you enter in OVA8 is strictly in the credit control area currency. If you have a global CCA denominated in US dollars and you set the document limit at 50,000 and then someone in Japan enters an order for 6 million yen.
You have to do the conversion in your head when setting it up.
Exactly. You have to make sure your limit settings mathematically make sense across all the global regions sharing that single CCA. It trips up a lot of implementation teams. Let us talk about the sneaky rep scenario. You mentioned this in the pre-show notes and I find it fascinating. The critical fields check.
Sales reps are incentivized to sell. That is their job. But sometimes that strong incentive drives some very creative behavior in the system.
Creative behavior. I love the diplomatic euphemism. Here is the classic scam. The rep tries to save an order. It blocks because the customer is legitimately over their limit. But the rep knows that cash on delivery or prepayment payment terms completely bypass the credit check because logically there is zero risk to the company.
Right, if they pay up front, who cares about the limit? So the rep changes the terms.
They go back into the order, change the payment terms field to prepay, and hit save. The system sees the safe terms and releases the block. The order is greenlit.
Okay.
Then, and here's the trick, they go back into the order a second time via VA02 and change the terms back to net 30 so the customer does not actually have to prepay.
Wow. And the system just does not catch it.
In a basic out-of-the-box setup. Now, the order's already released, so it sails right through. But if you are a smart consultant and you activate the critical fields check in OVA8, you can designate payment terms as a protected trigger field.
So if they edit it after the fact?
If they even touch that field after the order is saved and released, the system says, whoa, you just manipulated a critical risk parameter. I am instantly resetting the status to blocked and forcing the credit check to run all over again from scratch. It shuts down the loophole completely.
That is incredibly devious, but absolutely necessary. There is one last check in OVA8 that seems to cause the most headaches for support teams. The oldest open item check.
This is what I call the discipline check. It honestly does not care about your credit limit at all. You could have $1 million of completely free, unused credit, but if you have one single invoice that is overdue by more than, say, 10 days, the system drops the hammer and blocks you.
One invoice, even if it is for a tiny amount, like $10.
Even if it is for 10 cents. I have a legendary war story about this exact check. I was on a recovery project for a very large chemical distributor. The CEO calls me directly on a Tuesday morning, absolutely furious. Their biggest client, a huge agricultural firm, is hard blocked. Trucks are backed up out the gate. He says to me, I know they have credit, just increase the limit right now.
And what did you find?
I looked at the master data limit. They had $500,000 of available room, but the order status was unequivocally blocked. So I checked the credit logs. The log specifically said, oldest open item.
Okay.
I dug into the AR ledger in finance. I scrolled through all of their payments. I found a single lonely invoice from 3 years ago. It was for 13 cents.
You cannot be serious. 13 cents.
13 cents. What happened was someone had paid a massive invoice 3 years prior, but transposed a single digit on the wire transfer, leaving a tiny residual balance. Nobody in finance ever bothered to write it off and clean it up. It just sat there, aging. When we finally turned on the oldest open item check to improve collection discipline, that 3-year-old 13-cent debt instantly shut down a $1 million supply chain.
That is genuinely terrifying from a business operations perspective.
It is. And the main lesson for anyone listening is this. If you are going to turn on the oldest open item check, your data hygiene in accounts receivable must be absolutely spotless. You cannot have garbage residual pennies floating around in your open items, or your business will grind to a halt.
That story transitions us perfectly into segment 3, troubleshooting. Because when that CEO called you yelling, you did not just guess at the problem. You had a strict protocol. Let us teach our listeners that protocol today. Phase 1 is validation.
Right. Rule number 1 of consulting. Never, ever blindly trust the user who says an order is blocked. Validate it yourself. Go to Transaction VA03. Display sales order. Go into the header status tab. You are looking for the credit status field,
Which technically is VBUK-CMGST.
That is the technical database name, yes.
Mm-hmm.
You want to see exactly what letter is sitting in that field. If the letter is A, the credit check ran and passed, the user is confused, it is not blocked at all. If it is D, it was blocked originally, but someone with authority already released it. If it is B, it is genuinely blocked right now. But, and pay close attention here, if that field is completely blank...
Blank means no check even ran.
Correct. If it is blank, and the user thinks it should have been checked, you have a fundamental configuration breakage. Maybe the credit active flag on the specific item category is missing. Maybe the risk category fell off the customer master. A blank status is a much deeper architectural problem than a standard B status.
Okay, assuming we validate it and we have a B, we move to phase 2, the black box.
This is the single most underused tool in all of SAP SD. The credit check log. While you are sitting there in the sales order, you go to the top menu bar, you click Environment, then Logs, then Credit Management. This log is the flight recorder. It tells you exactly which specific check failed in OVA8.
So it will literally spell out static limit exceeded or oldest open item.
Yes. In plain text, people waste countless hours calculating numbers manually on scratch pads, trying to figure out if it is the exposure limit or a date issue. The log just tells you. It says, I blocked this document because of the oldest open item. Boom! You instantly stop looking at the limit calculation, you pivot, and look for the old invoice. If you do not read the log first, you are just guessing. And consultants who guess eventually get fired.
Harsh, but totally fair. So phase 3 is data analysis. We need to verify the numbers the system is claiming.
We call this the truth test. Let us say the log says the exposure is $105,000. The limit is $100,000. Is the actual exposure in the real world really $105,000?
How do you check?
In the old ECC world, you go straight to Transaction FD33. You look at the status view. In modern S/4HANA, you go to Transaction UKM_BP. You navigate to the credit segment data. You are comparing the system's aggregated belief about the debt against the detailed reality.
And this leads us to phase 4, root cause determination. And you have broken this down into 3 scenarios. Scenario A is the boring one. The customer is actually just broke and over their limit. Scenario B is the ghost. And scenario C is the oldest item we just discussed with the 13 cents. Let us talk about scenario B, the ghost exposure. This honestly sounds like a system bug.
It effectively is a bug, or rather a data corruption issue. In older versions of SAP, credit exposure is not calculated on the fly. It is stored in aggregate information structures. Specifically, tables S066 for open orders and S067 for deliveries and billings.
Okay.
These tables are updated asynchronously, meaning when you hit save on an order, the system says, okay, I will update the master credit table in a second in the background. But sometimes if the system crashes or a custom user exit fails or the server just blips for a microsecond,
The order saves successfully, but the credit table update fails.
Exactly, or vice versa. You end up with a fractured situation where the physical order is delivered and closed, but table S066 still statically thinks it is open. It is permanently holding on to a ghost value.
So your exposure looks artificially high to the system.
Yes, you manually add up the real open orders line by line, and you get $80,000. But the system's status view says 120,000. That $40,000 invisible gap is the ghost.
So how do you bust the ghost? How do you fix the corruption?
You have to run a hardcore correction program. The famous, or rather infamous, RVKR-ED77.
Why infamous? That sounds ominous.
Because it is an absolute nuclear option. When you run it, it completely locks the credit tables. It painstakingly reads every single open document in the entire SD system, line by line, and rebuilds the aggregate credit values from scratch.
Oh, wow.
If you foolishly run RVKR-ED77 at 10 in the morning on a busy Monday, nobody in the entire company can save a sales order until it finishes. You'll bring the entire commercial business to a grinding halt.
So you definitely want to run it at night.
Run it at night or on the weekend when nobody's actively working.
Oh.
But you absolutely must run it periodically if you have ghosts in the machine.
Let us pivot to resolution. We have diagnosed the problem. How do we actually fix it and get the trucks moving? We have the Band-Aid and the cure.
The Band-Aid is transaction VKM3, or sometimes VKM1. This is the manual credit release tool. A credit manager logs in, sees the blocked order, selects it, and clicks the little green flag icon. It forcefully overrides the system. It pushes the order status from B to D. It completely ignores the limit. It says, I know you're over the limit, but ship it anyway.
Does it fix the underlying exposure math?
No, not at all.
Yeah.
That is why it is just a Band-Aid. The customer is still technically over their limit. The very next order they place an hour later will block again immediately.
So what is the cure?
The cure is adjusting the master data. If the customer is legitimately growing their business and paying their bills well, stop annoying everyone by releasing orders manually every day. Go into the credit profile and formally increase their limit. Adjust their risk category. Solve the problem structurally so the system works for you, not against you.
Now, we need to address the massive elephant in the room, S/4HANA. I have heard absolute horror stories about clients trying to upgrade to S/4 and realizing their entire historical credit management strategy is completely broken. What actually changed?
Everything. Literally everything. In ECC, the old version, credit management was tightly built inside the sales and distribution module. It lived in table KNKK. It was a native, tightly integrated submodule.
Right.
In S/4HANA, classic SD credit management is technically dead and buried.
Right.
It has been entirely replaced by a module called SAPFSCM, Financial Supply Chain Management.
Wait, replaced? It's not just a software upgrade.
No, it is a completely different technical architecture.
Yeah.
The actual mathematical credit check does not happen inside the SD module anymore. When you save an order in S4, the SD module fires off a message, technically a web service or an RFC call, out to the FSCM module.
Okay.
FSCM receives the message, calculates the exposure over there, checks its own rules, and then sends a pass or fail answer back to SD over the wire.
That sounds incredibly disconnected compared to the old way.
It is entirely decoupled. The benefit is it allows huge corporations to run credit management on one single central FSCM server that services multiple different external ERP systems globally.
Ah, I see the enterprise value there.
But for the day-to-day consultant, it means all your old familiar tricks do not work anymore. Transaction FD32 is gone. If you type it in the command field, you just get a hard error.
Wow.
Table KNKK is completely empty. It is a fossil. You now have to use the Central Business Partner transaction, BP, and navigate to the specific role UKM 000 to see credit limits.
What about our engine room? Do we still use OVA8 for configuration?
Weirdly enough, yes. OVA8 somehow survives the purge. But inside OVA8, there's a brand new checkbox labeled SAP Credit Management. If you tick that box, you are explicitly telling the SD system, do not use the old internal logic. Call FSCM instead. And there is a critical BADI, a business add-in, called UKM_R3_activate.
Uh-huh.
If your developers do not activate that specific BADI, the connection between SD and FSCM is just dead air. I have seen multi-million-dollar upgrade projects delayed by weeks just because nobody knew to flip that one technical switch.
What about the Band-Aid? Do we still just release orders with a green flag and VKM3?
You technically can,
Yeah.
but S4 heavily pushes you to use a new concept called Documented Credit Decisions, DCDs.
What is that?
It is a total game changer for financial compliance. In the old days, a manager just hit the green flag. No required notes, no robust audit trail, just released.
Right.
In FSCM, a block automatically generates a case, a DCD. It is like a secure digital folder. The credit analyst opens the DCD in their inbox. They can attach a PDF of the customer's latest financial statement, can type a detailed note saying, spoke to CFO, promised payment wire on Thursday.
Oh, I see.
Then they formally approve the DCD, which in turn releases the SD order.
That is actual trackable case management.
Exactly. It moves credit from being just a technical switch you flip to a fully auditable business process.
Yeah.
It is much more robust for SOX compliance, but obviously it requires much more initial setup.
We are coming into the home stretch here. I want to make sure we give the highly technical listeners, the ones who actually debug AB app code, some real red meat. Segment 5, the technical deep dive. If I am debugging a block in the system, where am I putting my breakpoints?
If you're looking for the main code that drives the bus, you want to look for the function module named SD_order_credit_check. That is the main traffic cop that routes the data.
Got it.
If you want to see the actual math, where the exposure is physically summed up bucket by bucket, look for the module check_credit_limit. And of course, if you're in S4HANA, you are hunting for the proxy calls heading out to FSCM, which is a whole different debugging beast entirely.
And the database tables, you mentioned KNKK is dead in S4. What replaces it for reporting?
The new core truth table in S4HANA is UKM_BP_CMS_SGM.
That is a mouthful.
It stands for Credit Management Segment. That is exactly where the actual limit and the real utilization numbers are stored. If you're writing a custom ABA report in S4, do not query KNKK. You will get absolutely zero results. You must query UKM, BP, CMS, SGM.
Talk to me about user exits. Because standard SAP is great, but it is rarely enough for a complex business.
True. The absolute classic user exit for credit is LDKMPFZ1. Here's a very common business requirement. The business comes to you and says, we never, ever want to check credit for sample orders. Let us say order type ZSMS, regardless of who the customer is or how much they owe us.
Right, because it is just marketing material.
Staver Config can mostly handle this, but sometimes it is tricky with pricing procedures. In LDKMPFZ1, an ABAP developer can write literally 5 lines of code, basically saying IF order type equals ZSAMA, bypass check entirely. It gives you the ultimate programmatic flexibility to override the standard system logic whenever the business demands it.
Finally, let us do the gotchas, the weird edge cases that trip up even the seasoned experts. Number 1 on your list, the free sample trap.
This one is just embarrassing when it happens. You send a free sample to a customer. The net price is $0, but the order blocks for credit.
Wait, how does a $0 order exceed a credit limit?
Because the specific item category used for free goods, let us say 10N, has the credit active flag checked by mistake in transaction VOV7. The system mathematically calculates the value of the order, which is 0, but then it still checks the customer's overall status.
Huh.
If the customer is heavily overdue on other, completely unrelated regular orders, the system blocks the free sample just on principle. The fix is simple. You have to go into VOV7 and explicitly uncheck credit active for your free goods item categories.
Number 2 on the gotchas list, taxes.
Oh, this one causes immense pain, especially in Europe and Brazil with complex VAT. Imagine a customer has a credit limit of exactly $100. They place an order with a net value of $100.
Okay, so they are right at the limit, but not over.
Right, but there is a $20 tax applied.
Right.
So the total gross value of the document is $120. The system always checks the exposure against the gross value, so the order hard blocks.
Because the customer still has to pay the tax liability to you.
Exactly. Consultants often calculate and set the master credit limit strictly based on projected net revenue, completely forgetting that the customer has to absorb the tax hit too. You must mathematically buffer your master limits to account for average VAT rates.
And the final me to be. Gotcha. Number 3, currency fluctuation.
I call this the overnight block.
Yeah.
Imagine a customer is located in the UK, so their local currency is British pounds. But your global credit area is managed in US dollars.
Okay.
They order goods, and they are sitting comfortably at 99% utilization of their limit. They go to sleep. Overnight, the macroeconomy shifts, and the pound drops significantly against the dollar.
Oh,
Without placing a single new order, the translated value of their existing debt in US dollars rises mathematically. They hit 101% utilization in their sleep. They are blocked the next morning.
that is wild. How do you even fix that?
You need to meticulously update your exchange rates daily in Table OB08, and you must schedule RVKRE77 or the FSCM equivalent to run regularly to realign the translated exposure values. Otherwise, you get phantom blocks.
It really is a living, breathing organism, isn't it? It is not just static data.
It is entirely dynamic. It shifts and changes with the market, with the currency fluctuations, with the exact time of day.
So as we wrap up this deep dive, if our listener is sitting in a job interview tomorrow or sitting in front of a highly skeptical client CFO, how do they sound like the smartest person in the room?
By not using basic support language. Never say, I will go check why it is blocked.
What should they say instead?
Say, I will analyze the credit log to distinguish between the static limit and the oldest open item check, and then I will mathematically reconcile the calculated exposure against the open deliverables in the credit segment.
That sounds incredibly expensive. I love it.
And if you really want to drop the mic on them, casually ask, are you using the classic VCAM3 workflow, or have you fully migrated to documented credit decisions in FSCM?
That is the S4 Anaflex right there. Any final thought from you before we sign off?
So just remember the core philosophy. The credit block is not an error message. It is a deliberate business decision codified into software. Your job as a true consultant is not just to make the red error go away for sales. It is to ensure that the error only appears when it absolutely should to protect the company's cash flow. If you can confidently explain that philosophy to a CFO, you will be the most valuable person on any project.
A guardian indeed. Well, thank you for taking us into the deep end today. This has been incredibly enlightening.
My pleasure entirely.
Yeah.
Happy troubleshooting out there.
And to our listeners, thank you for joining us. Now go check your system logs. What if, in the future, the system didn't just block based on past data, but used predictive AI to forecast a customer's bankruptcy months before it even happens? Think about that. We will see you in the next deep dive.